We all face it, right? That challenge of having just enough of something, whether it's food in the fridge or, I don't know, books on the shelf. There's always that tricky balance between having way too much, which is wasteful, and, well, too little, leaving you unprepared. Today, we're taking a deep dive into how businesses tackle this exact problem, specifically with their inventory. We're going to look at a really powerful concept called the economic order quantity, or EOQ for short, our mission, to unpack EOQ, figure out what goes into it, and see how it helps businesses and maybe even you cut costs and boost efficiency. Before we dive deeper, just a quick reminder, this deep dive pulls heavily from Farhat lectures. All the content, the examples, the explanations, it's all derived from the great accounting resources over at farhatlectures.com. So whether you're an accounting student prepping for the CPA exam or already a professional, definitely check out the website. They've got extra practice questions, video lectures, lots of support to really nail down today's topic. A big thank you to Professor Farhat for making this material available.
Okay, so this idea of just enough.
It applies directly to business inventory. It really is like walking a tightrope, isn't it?
It absolutely is. A very fine line.
Yeah, on one side, you've got the risk of holding way too much stuff, and on the other, the danger of just not having enough when you need it.
Precisely. And falling off either side, well, it has real consequences. Holding too much inventory overstocking, that ties up cash.
Yeah.
Valuable working capital.
Right. Money you could use elsewhere.
Exactly. For R&D, marketing, maybe upgrades. It's a classic opportunity cost.
Plus, you've got higher storage costs. Think rent, utilities, insurance, even the labor just to manage and count all that extra stock. And then there's the risk stuff gets old or spoils.
Obsolete, yeah.
But the other side, understocking, is just as bad, really. If you have too little, you run into stockouts.
You mean you can't fill orders?
Right. You lose sales immediately. But maybe worse in the long run, you damage customer goodwill. Nowadays, if a customer can't get what they want from you quickly, they'll just go somewhere else. It makes total sense. Even thinking about, like, my own pantry or managing digital files, it feels like that same struggle, Finding that sweet spot between having what you need and just clutter.
Exactly. And to find that sweet spot in business inventory, the EOQ model focuses on balancing two main types of costs. These costs kind of pull in opposite directions. First, you have carrying costs.
Okay.
These are basically all the expenses that come with just holding inventory over time. So things like insuring the goods, the electricity for storage, staff time for counting, inspecting, even losses if items expire or get damaged. And crucially, these costs go up the more inventory you hold. So, for instance, in one of the examples we'll look at, the carrying cost is $1.75 per burger per year.
Got it. So more stuff equals higher carrying costs. What's the other side?
The other side is ordering costs. Sometimes people call them restaking costs. These are the fixed costs you pay every single time you place an order, no matter how big or small that order is.
Okay. Like delivery fees.
Yes, exactly. Delivery fees, the admin work to process the order, maybe the cost of someone's time to actually place it. Now, unlike carrying costs, these tend to go down overall if you place fewer, larger orders.
Right, because you're paying that fixed fee less often.
Precisely. But if you order huge amounts infrequently to save on ordering costs, what happens?
Your carrying costs shoot up because you're holding so much stock.
Exactly. You see the tension. In our sources, we see examples where this ordering cost might be, say, $15 per order placed.
So carrying costs go up with more inventory. Ordering costs go down if you order more at once. There must be a point where they kind of meet in the middle. What's EOQ actually trying to do with these two?
That is exactly what EOQ is all about. It's the genius of it, really. It's a mathematical tool designed to find the precise order quantity that makes the total of those two costs, carrying and ordering, as low as possible.
So it's not guesswork.
Not at all. It's calculated. The goal is that specific order size, where your total annual carrying costs plus your total annual ordering costs hit their absolute minimum. And ideally, right at that EOQ point, the total annual carrying cost and the total annual ordering cost will actually be very close, almost equal in theory.
Wow. Okay. That mathematical precision sounds really useful. Can you actually walk us through the formula? What are the pieces?
Sure. The economic order quantity, EOQ, is calculated like this. It's the square root of a fraction. On top, you have 2 multiplied by the annual sales figure, multiplied by the ordering cost per order, and on the bottom, you have the carrying cost per unit per year.
Okay, so square root of 2, annual sales, ordering costs, carrying costs. Let's break that down again.
Right. Annual sales, that's your total demand. How many units you expect to sell or use over a whole year. Ordering cost, That's the fixed cost each time you place an order. We talked about that $15 example. And carrying cost, that's what it costs to hold just one unit in stock for an entire year, like the $1.75 per burger. Essentially, the formula guides you to the point where the money you spend placing orders all year is almost perfectly balanced by the money you spend holding the average inventory that results from those orders.
Okay, that clarifies it. Let's make it real, though. Let's use that burger business example from the sources. This is where it clicks, I think.
Absolutely. Great idea. So imagine this burger place. They figure they'll sell about 4,600 burgers in a year. Every time they order patties from their supplier, it costs them a flat $15. That's the ordering cost. And keeping one burger patty in their freezer for a whole year costs them 75 cents. That's a carrying cost.
Okay, got the numbers.
So we plug those into the EOQ formula, square root of two $4,600, 75. When you run those numbers, the source material indicates the optimal order quantity is actually 2,500 burgers.
2,500. Interesting. So theoretically, they should order 2,500 patties at a time to keep their total inventory costs down.
Correct. Now, just to show why this matters, let's imagine they didn't use EOQ. Let's say, just for argument's sake, they thought, let's order all 3,600 burgers we might need for the year, if sales were 3,600, in one giant order to save on delivery fees.
Okay, one huge order.
Yeah. Their average inventory throughout the year would then be half of that, so 1,800 burgers, 3,600 divided by 2. Now calculate the carrying cost. 1,800 burgers times 75 cents per burger.
That's $1,350.
Right, a huge carrying cost. But their ordering cost, they only placed one order, so just $15. Their total inventory cost for the year in that scenario, $1,315 plus $15, $1,365.
That is such a massive imbalance. Just $15 for ordering, but then they're stuck paying $1,350 to hold all that stock.
Yeah.
It really shows how focusing only on minimizing one cost, like ordering, can make the other costs explode, leading to a much higher total expense. Finding that balance is key.
Exactly. It drives home the need for that equilibrium.
Okay, let's switch gears. Let's try another example to really hammer this home. Hiking boots this time. How does EOQ help a retailer selling those?
Yeah, good one. This shows how it works in a different setting. So picture a retailer. They sell 600 pairs of hiking boots annually. Keeping one pair in stock for a year costs them $3. That's the carrying cost. And placing an order with their supplier costs a fixed $20 each time the ordering cost.
Okay, 600 annual sales, $3 carrying cost, $20 ordering cost. Got it.
So we apply the EOQ formula again, square root of $623. You run the calculation, and it comes out to about 89.44 pairs.
89.4. You can't order 0.44 of a pair of boots.
Exactly. So practically speaking, they'd round that. Order 89 or maybe 90 pairs each time. That's their optimal quantity according to EOQ.
Okay, so EOQ says order about 90 pairs. How does that compare to, say, just picking a round number like 100?
Good question. Let's compare. What if they decided, without EOQ, just to order 100 pairs at a time? Seems reasonable, right?
Yeah, round number. Easy.
Okay, if they order 100 pairs, their average inventory is 50 pairs, 100 divided by 2. Total carrying cost for the year, 50 pairs times $3 per pair equal $150.
Yeah.
To sell 600 pairs a year, ordering 100 at a time, they'd need to place 6 orders, 600 divided by 100. So total ordering cost, 6 orders times $20 per order, $120.
Right.
Add those together. $150 carrying cost plus $120 ordering cost equals $270 total annual inventory cost.
$270. Got it. Now, what about using the EOQ number, that 89.44?
Okay, let's use the EOQ of 89.44 pairs. Average inventory is 89.44 divided by 2, which is 44.72 pairs. Total carrying cost. 44.72 pairs times $3, $134.16.
Okay, lower carrying cost. That makes sense. Less inventory on average.
Right. Now, the number of orders, 600 total pairs needed divided by 89.44 pairs per order equals about 6.708 orders per year.
Slightly more orders than before.
Yes, but more frequent. So total ordering costs, 6.708 orders times $20 per order at $134.16.
Oh, look at that. See, the total annual ordering cost is $134.16. They're almost identical.
Exactly. That's the magic point. So the total cost is $134.16 plus $134.16 and 32 cents. So $268 or 32 cents using EOQ versus $270 ordering 100 at a time. Now that difference, $270 versus $268.32, might seem small in this one example, just under $2.
This does seem small here, yeah.
But you have to think bigger, right?
Right.
Imagine a company with thousands of different products in inventory.
Absolutely.
Making these slightly more optimal decisions on every single item, order after order, year after year. Those small savings, add up incredibly fast.
It becomes significant. It directly impacts the bottom line, improves cash flow, frees up capital. It's not just about pinching pennies, it's fundamental operational efficiency.
Which leads to a really important question. Why should someone listening care about this if they're not managing inventory for a big company?
That's a great point. Why is this relevant beyond, a business class or studying for the CPA exam? What's the takeaway for you, the listener?
Exactly. Beyond the burger shop or the boot store, how does this EOQ idea actually touch our lives or decisions? Well, EOQ, really, it's a basic principle of optimizing resources. It's not just for widgets in a warehouse. It applies to pretty much anything where you have a cost to hold something and a cost to get it.
Well, like what? Give me an example.
Okay, think about household stuff, toilet paper. Do you buy that giant 36-roll pack once every few months or a smaller 6-pack more often?
Yeah, I see.
You're kind of intuitively balancing the space it takes up in your closet that's like a carrying cost against the hassle and time of going to the store more often. That's like an ordering cost. Or even think digitally, your email inbox, cloud storage.
Oh, yeah.
If you never clean it out, you accumulate tons of digital clutter, maybe even pay for more storage eventually. That's a carrying cost. But if you spend time meticulously organizing it every single day,
Yeah.
you're spending a lot of effort. That's like an ordering or processing cost in terms of
Right, you're
time.
getting the balance.
Exactly. That core idea, balancing two opposite costs to find the sweet spot that minimizes your total effort or cost or stress,
Yeah.
it's useful everywhere. It just helps you think more strategically about how you use your resources, whether it's money, space, or even your time.
It's about being smarter, really, making better decisions to get the most value. It gives you a framework for thinking about these trade-offs.
Absolutely. So just to recap, today we dove into the economic order quantity, EOQ. We saw how it helps balance those carrying costs and ordering costs, steering clear of having too much or too little. It's about finding that mathematically just right point.
So as we wrap up, here's something to think about. What's the inventory in your life? Could be groceries, could be information you consume, maybe even the tasks on your to-do list. Where could an EOQ-style balancing act help you out? How might optimizing your own orders and storage lead to maybe a bit more efficiency, maybe a bit less stress? Something to ponder. Thanks for joining us for this deep dive.